Dear all, a warm welcome to this UCITS 2022 webinar series that explores the various facets of the investment management fund industry and dedicated to liquid funds. So today we're going to talk about UCITS delegation and oversight. And to do this, I have really the pleasure to welcome Jasper Ronda, who's a senior manager with Arendt Regulatory and Consulting, and Piotr Gimzo-Popovski, which is a counsel within the investment fund managing practice within the law firm.
Hello.
So before we jump in, as usual, some words on the housekeeping. So you have a Q&A that you can use. So please send questions to the panelists, and we will have a short time right at the end when we can go through it. If you have plenty of questions, obviously we will look at that at a later stage and come back to you on a second time. You can also communicate through the chat if you have any technical issues. So please let us know. Now, among the activities that an IFM may in principle delegate, the following tasks are noteworthy. Among others, the functions including in the activity of collective portfolio management as defined in Annex 2 of the 2010 law. This is how Circular 18698 starts with this very important chapter on delegation. Obviously, and as our colleague of Arendt has reminded very recently on the podcast on outsourcing, delegation is not something new. I think the Luxembourg market has really grown on the ability of EFM to be in a capacity to delegate functions and to have in Luxembourg, obviously, service providers that were able to deliver these services locally. But the success also of this model has been based on the fact that you have very strong regulation, you have a framework that is very well defined, and the Circular 18698 was a testimony of that, and is still something that is very well welcome when it comes to delegating and using delegations. So in today's sessions, what we'll do is we'll go through the CSSF approval process. We want to focus on portfolio management, which is obviously key in the UCITS world. Have a word around delegation and outsourcing and how these rules play out between the new circular, the 22806, and also touch on the potential change coming on these rules of delegation. Right, so jumping in, Piotr, I think you wanted to first start and introduce us with the CSSF approval process.
Indeed. So welcome everyone. Thank you very much, Stefan, again for the welcome and for the great introduction. It's a real pleasure to be with you today. So indeed, as Stefan already said, there is a robust framework in place that deals with delegation. And indeed, most of the delegations require the CSSF approval. And that is something that needs to be borne in mind because that has an impact on timing, then has impact on the updates of the documents, etc. So what are kind of the basic elements of the CSSF approval process? Of course, they will vary depending on the delegation in place. But first, the rationale. So what our clients often overlook is the fact that when you delegate, you will need to have a reason why you delegate. It will need to make sense. It will need to be of the benefit ultimately for the investors in the fund. So we need to prepare a rationale that we will explain to the CSSF in the filing email. Then, of course, there will be a submission of documents. And we will go in a second through the documents that are to be submitted and why you need to submit those documents, what is the purpose of that. But also you will need to amend often your prospectus, or if you're launching a new product, you will need to make sure that you have the proper description of all the functions. And again, from experience, delegates will want to review the sections that they are describing their functions. So there needs to be timing factored in for that. Then, of course, everything will need to be approved, and that's very important because the CSSF does ask more and more during on-site inspections, but also during audit. The auditors are always asking, where are the corporate authorizations authorizing this delegation? Where is the evidence of the discussions that were held? Where is the evidence of the due diligence that was conducted, rationale for the delegation, etc.? So all of this needs to be documented in corporate authorizations. And often there will need to be notice to investors because this will be an important event in the life of a fund. So the investors will need to be notified, often even with a 1 month prior notice, especially if it's a change of a major service provider like a central administrator, for instance. But now we go into the details. So now we will go through the documents, and I hand over to Jasper for that.
Thank you, and also welcome from my side. I think to start with, what's important to note is for which functions you actually need CSSF approval for the delegations that you want to put in place. So CSSF approval is required for portfolio management, for administration, for valuation, and for the control functions, so risk management, compliance, and internal audit. What we have on this slide is the standard set of documentation that needs to go to the CSSF in any case. I think the migration plan, obviously, that is a bit specific to delegation or change of delegate for administration and also depository. Not knowing that the depository function obviously is not a delegation as such. I think we'll get to the content of that due diligence in a minute, but I think it's important to note that you can either submit a confirmation of satisfactory due diligence. We know that some clients prefer to actually submit the actual due diligence packs to the CSSF. In any case, it's important to have them, obviously, because the CSSF will, in any case, require them in an on-site visit. So it's not done with the confirmation that you have done a due diligence. You actually need to have done a due diligence. So again, some clients provide this upfront. And some clients opt to only submit the written confirmation, the written summary of the due diligence to the CSSF. So there are various approaches there. Now, with regards to portfolio managers, the list is a little bit longer. It might be a bit complicated to submit some of these documentations. For instance, proof of registration with relevant supervisory authorities is not that easy, or sometimes simply not possible, depending on the jurisdiction of that portfolio managers. What we see in many cases as well is that there are certain restructurings in the group of the portfolio manager. So teams merge into another entity, and therefore the legal entity to which we delegate portfolio management is a new one. So some of the documentation that we see here, the classic example would be financial statements for the last 3 years. They will simply not be available. Now, that is not a problem as such, as long as we can give the CSSF the comfort that they are looking for. So the obvious and general idea behind the submission of these documentation is that the CSSF can ensure that there is no reputational risk for the investment fund manager in question, but also the Luxembourg financial marketplace as a whole, that there is no risk of anti-money laundering and so on.
Thank you, gentlemen. I think what we see from this already is that so you need a bit of anticipations. You need to plan ahead your delegations. You need to have your due diligence done already, the contractual agreements which are being reviewed, and effectively you provide and collect these informations. Now, this is all when everything goes quite well, but I think this is not always the case. So, what would be in your expertise and with what you have viewed the hurdles or some of the issues that you have encountered into this CSSF process and this authorization process?
Yes, so indeed, this is kind of course, the ideal scenario, and as already mentioned by Jasper, not all of these documents are always available, and some of them sometimes do reveal some problems with the entities being not deemed for purpose. So, of course, what are the main discussion points? So, by far, the most important is indeed the due diligence. So, as was already mentioned by Jasper, it's very important that the initial due diligence is conducted, and it's very important that it's well documented. So, it's even often with intra-group delegations, we see questions on, okay, well, we know our group entity, well, we have whole processes, we work as a whole group, what should we do? But it's still very important that the information on the manager is gathered, on the track record, on the people involved, who are the key individuals, etc., and that there is really proper consideration of that by the management company. There are proper corporate authorizations in place, and ideally by the fund board. Then, of course, there is also the regulator-to-regulator process. So now, routinely, the CSSF does contact, for instance, when we appoint a new investment manager, which is going to be a regulated entity in another jurisdiction, the CSSF will routinely contact the other regulator to double-check that indeed there are no sanctions, there are no issues pending, no investigations. And, of course, that takes time. Sometimes that reveals some unexpected findings, so that is also very important that when we have the submission process, please be as honest as possible. Even if there is a minor sanction or a minor breach that you think, okay, well, no one will ever pick up on that, please do disclose, because then that allows us to anticipate when it gets disclosed only in regulator-to-regulator process, it really reflects bad on the filing. Then, of course, termination rights. So one of the things, as Stefan already mentioned, we will need to have the contracts ready for the submission, and then there is discussion, okay, how much notice do I need to give, how much notice, what is the least notice I can give, and here again we see between 30 days and 90 days, not less than 30 days, because then the CSF really starts asking questions about, okay, how will you ensure proper handover in case of a new incoming service provider, and if it's longer than 90 days, well, how do you ensure that you can act quickly if it's really in the interest of the investors? Then think about the update to the AML CFT market entry form. It will not always be required, but certainly for instance, portfolio management or for any changes to the distribution structure, it will be required. And that often requires, with a new portfolio manager, we often have new asset classes. So those new asset classes, there will need to be AML due diligence on the new asset classes. So that will need to be completed. So that will again take time, it needs to be anticipated. And then, especially for administration function, outsourcing is often widely used in the industry. So the administrator in Luxembourg will rely on its global network to perform various functions. So again, what needs to be ensured is that all of these arrangements are well documented, well disclosed, that there is prior consent, because the 1993 law on financial sector requires the client's prior consent to outsourcing, so that there is evidence on that. That there are therefore ideally some corporate authorization board resolutions mentioning that the board of the fund or the management company reviewed the outsourcing arrangements, that they are happy with those outsourcing arrangements, and that there are no questions on the model, especially that, and many of the jurisdictions will imply non-EU jurisdictions, so there will be questions on data protection, on assurance of confidentiality, so all of this will need to be properly considered and tackled.
Something that we saw on the termination rights is that clients and delegates of clients actually tend to not like a general statement that an agreement can be terminated with immediate effect in the interest of investors, but actually that the contract mentions what are situations, operational situations, regulatory hiccups that sort of trigger that right to immediate termination, rather than having that general right, which, I mean, if you put it very general, is prone to create issues as to what such a situation might be.
No, agreed, absolutely agreed. And also it's important to note that it's not necessarily always required to have kind of immediate termination rights. So what we sometimes see is indeed, even if you have a 90 days right, if it still allows the fund to act relatively quickly. There will be some discussions, but indeed we can foresee some minimum notice periods. It's just that there is notice and that there is the ability to terminate. And I fully agree that, especially with, for instance, third-party manager platforms, the managers will review very carefully what are the termination rights and why can they be terminated on the platform. Absolutely something to bear in mind.
I think that in the list that you have here, again, I want to emphasize the timing issues. We had to deal quite a lot with the clients that have actually delegated, and they kind of forgot about the authorization from the regulator. In most of the cases that we had here, the regulator has shown a very good understanding of the situations, but nonetheless, I think it's very important for you guys to be reminded that there is an authorization. It's just not a notification only, so all that we have mentioned before. And indeed, I think one of the points that Piotr, you did mention right now, which is also a very common mistake, is the the intra-group due diligence is as important as if you were delegated outside of the group. So there are operational items in terms of key performance indicator that you would expect the service being rendered externally or within your group, which has to be covered. So this is certainly not something that you can bypass or treat lightly. So thank you, gentlemen, for this. I think it's very good elements to keep in mind and to avoid any issue when starting this delegation process. Now, so one of the objectives of today was really to do a focus on the portfolio management. And Piotr, so now that our audience has a good understanding of the whole process, can you lead us through some of the more specific points linked to portfolio management in the UCITS world?
Sure. So indeed, now with the AIFMD2, which will also update, which confusingly with its name also updates the UCITS delegation rules, there will be increased focus on portfolio management. And so there are fundamentally two big blocks of kind of issues that we discuss with the clients in the context of portfolio management. And one of the blocks is indeed the discretionary portfolio management versus investment advice. So, of course, as you all will be very much aware, and here the terminology is very confusing, especially with our American clients who call everything investment advisory agreement. Investment manager will be the entity that can actually make the decision, so that has actually discretionary power to take the decision and to buy and sell relevant instruments, whereas advisor will be the one that only renders advice, but does not actually have, and that's what you need to check in the contract sometimes, because we sometimes do get a question, well, is it investment advice, is it investment management that we're facing here? So an investment advisor will not have the discretionary power to actually press the button and buy and sell instruments. Therefore, there's of course different scrutiny, and where we see investment advice coming into place is indeed where the investment advisor is not regulated. For investment management, there is absolutely no exceptions. For UCITS, you have to be regulated and you have to be authorized for the purposes of portfolio management in your home country. And if it's a country that is outside of the EU, there needs to be cooperation agreements in place. Something important to check, because indeed many countries have multiple regulators, and not all regulators have the agreements in place with the CSSF. For instance, for India, if it's an SEBI regulated advisor, that's fine, but if it's regulated by another entity, that runs into problems. We have similar issues with Saudi Arabia, so something really to be looked into, and therefore indeed clients often resort to investment advice to cover that gap, to avoid the fact that need for the MOUs or the need for regulation. But then, of course, what is often overlooked by the clients is the MiFID considerations. Very often the mantra is, okay, we are in collective portfolio management, MiFID does not apply to us. Well, that's absolutely wrong, in the sense that indeed MiFID does not apply to the management company performing its activity of collective portfolio management, but it does apply to the delegation. And so here, the first question that we will need to ask ourselves is really, what is where is the service being rendered? Because depending on where is the service being rendered, we can ask the question, okay, what are the applicable regulatory rules? And here, there is no clear guidance, so that's important to stress. Even in the CSSF Circular 716, the CSSF does not give a clear explanation on, okay, for this type of activities, that's the place of service, for this type of activities, that's the place of service. However, it does give the steer that, the place of service is where the characteristic service is supplied. And on that, for investment management, there is consensus in the market, across jurisdictions actually in Europe, that investment management is deemed to be performed where the manager is located. Therefore, if it's a UK manager, well, they will just need to be authorized in the UK, and the portfolio management will be deemed in the UK. No passporting into Luxembourg necessary. However, where the advice is performed, that's usually where the advice is deemed received. So for a Luxembourg fund, it will be always in Luxembourg. So then you need to ensure, because that's an element that is routinely forgotten by the client, that, well, investment advice is a MiFID regulated activity, and even if it's provided by US entities, also a regulated activity. So you need to passport into Luxembourg. Luxembourg has a quite generous regime, again described in the CSSF Circular 716 for that. where even for countries that don't enjoy MiFID passporting rights like the US, UK, it allows passporting into Luxembourg under national regime, but it needs to be complied with. There are documents, formalities, unless you can rely on exemption. And of course, the most important exemption is the group exemption. So to the extent there is a link between the investment advisor and the recipient of the advice, and they are part of the same corporate group, then indeed, you can be exempt from the MiFID requirements. Then another point to consider with investment management and investment advice is the fee arrangements. So first of all, very often clients don't want to disclose at all any fee paid to investment advisor. They say, well, they are just advisor, they don't need to be disclosed. And indeed, there was for a long time gray zone on that. But now investment advisors will always need to be disclosed, because the pre-inception questionnaire for a new sub-fund, new product will require you to disclose that there is investment advisor involved, and therefore the CSSF will be aware and they will require prospectus disclosure. So then the second question they will ask, okay, what are the fee arrangements? How are they remunerated? And they will scrutinize it in quite a lot of detail. Important things, first, if there is sharing of performance fee, well, that needs to be disclosed, but also most importantly, what is the amount of the fee that is paid to the investment advisor? The idea being here that, of course, the regime for investment advisors is much lighter than investment managers, because the idea is that the ultimate decision, critical decision, is made by by the management company, etc., the entity that receives the advice, not by the advisor themselves. Whereas, of course, in reality, very often all the work is done at the level of the advisor, and then they, of course, want to be remunerated for that. And it's very important to think, well, that generally investment advice remuneration should be lower than investment manager remuneration. And then, as I mentioned already, all of these arrangements need to be properly disclosed in the prospectus, also for the investment advice.
Maybe just let pause here a moment, because quite a lot of information to be captured by the audience. So, can you say that portfolio management delegated, when you have an investment manager, is regulated in its own country? I mean, we are on the fairly green side of the scale.
Indeed.
Not regulated, or in a country that would not have a memorandum of understanding?
Well, not regulated is a no-go if it's indeed a manager. If it's in a country where there is no memorandum of understanding, it's still not a no-go. We had some situations where it was still ultimately accepted by the CSSF, but there is a lot of explanation, a lot of discussion, a lot of showing of the equivalency of the relevant regimes.
And so, moving to the investment advisor model, then obviously here not the issue, but the point in mind, the point to have in mind is that we're moving into a MiFID territory, and there's authorizations to be provided to the CSSF.
Yeah, that would be indeed the key point of focus. 2 points, the MiFID considerations, and make sure that you can either rely on an exemption or you are properly passported into Luxembourg, and the fee, make sure that your fee is disclosed, and that basically your fee is not, the advisor ultimately is not sweeping up the majority of the fee that is paid for portfolio management, because that will not be well received by the CSSF.
Thank you, Brill. Super clear.
And the oversight is different, of course, because in the one model you're sort of outside of the process because the decision is with someone else. So it's sort of mostly an ex post consideration of the relationship, while in the advisory model you are involved in the investment process. So the CSSF will want to see how investment advice is treated within the investment fund manager.
So then, second important area of focus is multi-manager models. So in particular, where we have multiple managers managing a single sub-fund, because it's almost always the case, or vast majority of the case, there will be multiple managers for the platform as a whole, but even within one sub-fund, there will often be different investment managers, and then the CSSF will ask questions. The first question they will ask is indeed what are the relevant responsibilities of the different entities, and in that they will focus on redundancy and on excessive costs. So you will need to produce a proper investment process flow chart where the value add of each entity is demonstrated. The value add can be demonstrated in different ways: specific expertise in terms of asset class, specific expertise in terms of jurisdiction. But it needs to be shown that it's not, for instance, that we have a group structure and that we have a lot of entities in the structure that delegate all the way down the chain, and everyone wants a piece of the cake, and therefore everyone will want to have a piece of the fee, and so you have an extensive delegation structure, because then the CSSF will question, okay, well, ultimately there are excessive costs in the structure for the investors. And then, of course, a very important other aspect is indeed the payment of the fee. So for performance fee, the performance fee is measured on a sub-fund as a whole basis, and that's a relatively new development. Instead, there was discussion on that before the introduction of the ESMA guidelines on performance fees, but now it's absolutely clear. And so if the sub-fund, if for instance we have an absolute return fund and we have a high watermark model, if the sub-fund as a whole has underperformed, it does not matter whether one of the managers have overperformed, no one will get paid performance fee. If there is a benchmark, it gets a bit more complicated. I don't want to go into too much detail at this stage. But then again, even if you manage two different benchmarks, you might ultimately not get paid performance fee in case of overperformance.
Pierre, is this a model that we see a lot, the multi-manager, and partially, when we are not talking about very specific asset pooling or asset class which is allocated? Is this something that asset managers tend to use a lot, or would you say that this is on the fringe and this is not used that much?
I wouldn't say it's mainstream, so I wouldn't say that for every product or we routinely have multiple managers, but I would say that indeed it's quite often. The reason for that is twofold. So one, you've already kind of mentioned, and I don't want to overemphasize it, but indeed for sub-funds with quite broad asset classes, especially for fixed income part and for the equities part, you will have quite often different managers. But also for geographies, if you have specific, if you have investment in like emerging markets, for specific emerging markets, for that pocket, you might have a specific manager. But also what we see more and more, and that's actually recently the trend, is that with the new kind of home working arrangements, etc., the managers want to give their star performers as much flexibility on moving around in the global network as possible. And therefore, you often have multiple managers because part of the team has just moved from one city to another. And so they've moved from, say, the manager in Milan to the manager in, say, Sydney. And so you then have two managers, and then you do need to delineate, okay, these people are dealing with this part. So that we really see quite often, and that's actually a new trend that is really post-pandemic, where there is really, the managers are saying, are coming to us, and the first question they are asking, and that's also in the context of top-up services, etc., is how much of mobility can we have? Because our top talent expects mobility. They don't ask about it, they just expect it. So we need to have a model which allows us to move people around the network on a quite short notice, quite flexibly.
Yeah, no, thank you. I think quite interesting to see that what's happening in the world is also shaping the way this delegation and outsourcing works. I suppose that on the other hand, also for management company, this is an additional no issue, but additional work, because the delegation, the oversight is going to be more complicated and more. And
it can be quite challenging, even because the CSSF thinks very much in terms of legal entity. So you have that legal entity in Milan that is the delegate, but then people move over to Sydney, and obviously that is another legal entity. So that can be, in terms of organizing the oversight and the due diligences and so on, that is more complex.
Thank you. Well, I think this is the right path or the right bridge between the points that we wanted to touch base today, because obviously all of you have probably seen this new CSSF circular on outsourcing, the 22806. And so, Jasper, could you brush and tell us what are the differences between the 806 and the 18698, which still obviously has this Chapter 6 on delegation, so it's very important. So how does it play together?
So I think the key message here for our clients is to understand that the Circular 22806 has a very broad scope. Investment fund managers are within the scope, but they are only impacted by the 22806 when it comes to the outsourcing of ICT. So we focus on portfolio management today. So the 22806 does not play a role in there. And another point I think that is important to consider also, if your delegate portfolio manager uses IT arrangement within the service that is provided to the investment fund manager, that is also not in the scope of the 22806. So again, the 22806 is about the outsourcing of ICT functions, and the 18698 is about the outsourcing of basically the remainder of the functions. They are listed in the circular in Article 94 as portfolio management, risk management, valuation, administration, marketing, accounting, compliance, AML, complaints handling, and internal audit. We had the list before which of these require authorization from the CSSF, so that is not for all. I think another important aspect to consider is that the mechanics in the 18698 versus the 22806, they are fairly the same. I think the 22806 is a bit more elaborate, potentially because it's also about ICT outsourcings on some aspects, but the global steps, they are the same. So first there has to be an initial due diligence. We mostly see mixed approaches here in terms of initial due diligence, so global approaches and operational approaches to due diligence. The circular provides for some guidance in this regard on aspects that need to be covered in that due diligence. So you have jurisdiction, governance, shareholding, reputation, and so on. So the general advice here is to have a good look at the circular and at that article in the circular that is actually a bullet list of things that one needs to cover. So it's an easy task. Basically compare the due diligence questionnaire that you have in place to that list and make sure everything is there. Now that's what we call the global due diligence. For portfolio managers, obviously there are more points to cover. We had those that Piotr mentioned, memorandum of understanding, the proof of regulation, etc. I mean, that can be covered in the due diligence questionnaire that is submitted to the delegate. That can also be covered by the investment fund manager itself. I mean, that normally is information that is on the websites of the local regulators or of the website of the CSSF, even when it comes to memorandums of understanding. And then in the context of portfolio management, you obviously also have the operational due diligence. So you look at the actual processes that are related to portfolio management, investment process, best execution, voting rights, personal transactions.
AML, a topic that is dear to my concern.
AML, but also one thing that is frequently forgotten is remuneration, because one cannot bypass remuneration rules by delegating portfolio management to an entity in the country that has less or less pronounced remuneration rules. So one has to assess the equivalence of the remuneration rules that are applied, not necessarily in that country, but by that investment fund manager, because very simply some countries do not have remuneration rules that we have, but then it has to be ensured that basically that these remuneration rules are still put in place. Now, at the end of that exercise of that initial due diligence, there is an identified risk level, and that will then in the end drive the frequency of the repetition of the periodic due diligence and the ongoing monitoring as well. And the conclusion of the due diligence, that needs to be a written one, it needs to be signed, and it needs to go to an approval committee. So that can be the board, it can be the management committee, it can be a committee composed of board members and conducting officers. We see a lot of different approaches there. In some cases we see basically that the board agenda has one element, approval of new relationships, or same for the management committee. So that is, again, we have numerous approaches here. Now what's important is to note that all of this has to be done before the contract is signed. We see, in many cases, we have seen the CSSF coming in for on-site visits and basically complaining that the contract has been signed and then the due diligence was basically the step to be done thereafter.
Can I try to defend the asset management industry here, Jasper, on that one? Because knowing the time potentially that you need for signing a contract and having a contract, I mean, can we see that there are some things that are done in parallel? I mean, you can do your due diligence and then there's a process of that contract being signed, and sometimes things are arriving a bit all together. Or
yes, but if I may jump in, of course, what's an important point, and that's also an important point in terms of the kind of overall, like also the intra-group due diligence, is that technically the due diligence should be an objective assessment which can lead to a result that someone is not fit for purpose. So having a signed contract in advance a little bit preempts that result, and I think that's the main concern of the CSSF.
Yeah, and I think even if you come across certain elements in the initial due diligence that you do not like or that are not complete, as long as they are not super critical ones, obviously you can go ahead, and then in your conclusion of the initial due diligence there is a note that this document has not been provided, but it's not so super important that we would block the basically proceeding with the delegation. But what is important is that these points are picked up again, because what you should not have is basically the initial due diligence exercise, and then you sign it, and then you basically forget about it. But if there have been points that have been raising an eyebrow or basically have come to the disliking of the people doing the due diligence, they need to be picked up and they need to be brought to the attention of the people basically giving the green light on the relationship.
And all these processes are risk-based. So there's an assumption that you would risk assess the relationship, and even for portfolio manager, I suppose that that would be the case, depending on the regulations, maybe the country where it is, and the model, and so that would drive also what you're saying in terms of review and oversight.
Exactly. So what we have to have at the end is basically a categorization of the risk of the relationship, and that basically drives then the repetition of the due diligence. So that would be the periodic due diligence, but also how often we have ongoing controls. So both the frequency of these ongoing controls, but also the nature of the controls that are applied. So obviously periodic due diligence, that is not, I mean, you do not have your due diligence questionnaire and you basically resubmit it every 2 or 3 years, but you do that in accordance with the risk rating that you have given to that relationship. And it's a living document as well. I mean, I think there are some elements that have been added to due diligence questionnaires over time. You mentioned AML. I think very recently we see the introduction of very ESG-related aspects in due diligence questionnaires as well. So these have to be added. And again, also, I mean, initial or periodic due diligences, the conclusion of these due diligence, they drive, as we said, the frequency of the then subsequent periodic due diligence, but also the ongoing controls. And then in terms of ongoing oversight, the idea is obviously to receive information that puts the investment fund manager in a position to assess the quality of the service that is provided to that investment fund manager. The circular mentions that we need to have detailed reports and KPIs. One thing that we often see is that basically also due diligence questionnaires and KPIs are sort of imposed on the investment fund manager. What's important is that there's an actual assessment of the KPIs and are we happy with them? And if not, then basically the investment fund manager should be in a position to say, look, we also want this and that from you. And then basically, so the definition of the own KPIs that must then be sort of fulfilled also by the delegate. Now, the typical KPIs in terms of portfolio management are, I mean, performance, I think, is the obvious one. Breaching of risk limits, or, well, yeah, basically...
all the investment restrictions,
compliance.
Exactly. And you have, I mean, you have operational incidents, we have pre-trade operational incidents, post-trade incidents. You can look at BCPs and basically the outcome of the BCP testings. You can look at the robustness of the IT at the level of the portfolio manager. So there are many aspects to look at.
So quite of task and work for the oversight people.
Yeah. We have seen a lot of due diligence reports where basically the reports, or the outcome of the due diligence was not super satisfactory. So there were some elements that were not right, and I think there it's very, very important that the CSSF finds trace in whatever minutes, board minutes, management committee minutes, approval committee minutes, whatever minutes, I mean, the minutes should be the right ones, obviously. But what's important is that the CSSF will see a trace of an analysis of the reportings that have been done. So if there is an issue that has been identified, the CSSF will want to see, okay, did they speak about it? Have they invited the portfolio manager to explain? Have they defined mitigation measures? Have they followed up on the mitigation measures? If that isn't there, but there is a hiccup in the relationship, then basically we have a situation that we shouldn't have. And obviously, I mean, all of this needs to be somewhat mentioned in a delegation policy, delegation procedure, outsourcing, or whatever you want to call it. But the way you do it, it needs to be manifested in the policies and procedures.
Thank you, Jasper. I think we at this last slide just to evidence that we see a lot of a manager with Drellmanco in Luxembourg, and we see the overlap in terms of topics and subjects to be covered. So there are some convergence in terms of the way controls and topics are covered. So I think this is just an illustration of that. Conscious of the time and moving forward, Piotr, I think and you've already made an allusion to it. You wanted to touch at the end of what's to come or not to come, actually. So what are the changes ahead?
Yes, indeed. So why is it kind of becoming topical again? Basically, even though the kind of everyone knows in the market the piece of legislation is AFMD2, because indeed there is now the overhaul to the AFMD regime that is being contemplated, that has been proposed by the Commission and is going through the various legislative stages. Of course, what the rules also entail is bringing up to standard the UCITS delegation rules with the AFMD delegation rules. So under the guise of AFMD2, there is actually also an overhaul of the UCITS delegation regime. And we've listed here kind of the key aspects of that. I will go very briefly through them. So most of them, as you will see from the green ticks, are already covered in Luxembourg in the local regulations. There is one aspect which is not, but that's actually still a helpful clarification. So disclosure of delegation arrangements as part of authorization application, well, that is already a standard in Luxembourg. Notification also in respect of top-up activities, meaning individual portfolio management and the MiFID top-up activities that the company can, management company can exercise under extended license. Well, again, this is already required as part of the top-up license process in Luxembourg. Justification of the entire delegation function based on objective reasons. So this is the famous rationale. You need to ask yourself, why do you delegate in the first place? Why is it of benefit for investors? And again, something that is already routinely asked by the CSSF, so nothing new for players familiar with the Luxembourg environment. Then there is a clarification on the fact that distributors acting on their own behalf should not be considered as delegates. And why is there a cross? It's not because it's a bad thing, it's just that it was not so clear before, but it's a welcome clarification now if it indeed will come into fruition in that shape, because these points are based on the latest council position, and this is still a work in progress. Then indeed it will be welcome to see that the distributors who distribute multiple products for various managers who are not kind of dedicated global distributor of a particular fund, well, they are not really delegates of the fund. They are acting on their own account, and you don't need to treat them as delegates. What is relatively, well, not again new, but where there might be some gold plating at the end is the regular and detailed reporting to supervising authorities, which is a welcome development, and that's kind of comes under the last point of the enhanced scrutiny on third country delegation. Unlike in the council, in the Commission proposal, the council draft does not foresee that there is specific reporting to be done on third country delegation with potential regulatory enforcement specifically focused on that. There is just global reporting done. And again, this is already in place, as Jasper said, there is already multiple, ongoing supervision by the CSSF of the relationships. What is new is the level of detail. So for instance, the council proposal at the moment wants you to show the percentage of assets under management that are subject to particular delegation, or the exact number of FTEs that are supervising a particular relationship. That type of detail, of course, will be difficult to ascertain for global models, and that is something what the industry is trying to push back on, and to be seen whether we will be successful in that.
Okay, thank you, gentlemen. I think we have a moment for questions. So in terms of questions, I think we have the questions on the multi-manager model and the delegate. So how do you if you have one manager per sub-fund, how precise do you need to be in terms of disclosure? I think that's the sense of the question.
Yeah, I think indeed. So for structures where you have different investment managers for different sub funds, or even multiple managers or sub investment managers for the same sub fund, indeed, clients often ask us how strict you need to be. Generally, the CSSF accepts the disclosure that basically these are all the investment managers that are potentially involved in the management of the UCITS, and they are managing the different sub-funds as appropriate in the process. So at the approval stage, you will need to show to the CSSF who manages what, but you don't need to describe it in the prospectus. So for instance, if you then have changes and the reallocations between the sub-funds subsequently because of the star personnel, which we've mentioned moving, you don't need to change your fund documents. So just generic disclosure is enough. What you cannot have is what the clients sometimes ask, approval in anticipation. So you want to approve an entity that is at the moment not managing any sub-fund, but you just want to have it already approved so that if someone moves to that entity or if you decide to reallocate, you can suddenly employ them as an investment manager. There the CSSF draws the line, and you only can have approved entities which as of today manage at least one product in the platform.
Thank you, Piotr. I think the time is up, so we had quite a lot of other questions, but as we say, we look at it and revert back to you with more. So thank you, Jasper. Thank you, Piotr, for this very detailed and interesting topic. I think again, this is something that we all have in our day-to-day and will continue to have, with interesting regulatory development to be followed up. There will be more on the UCITS series, so there's 3 more to come. So we will be absolutely delighted to have you on the next sessions, which will be in the current of October. I think you have the planning, which is now on your screen. Thank you very much for your time. It was a pleasure to have you, and see you soon. Thank you.
Thank you.
Thank you very much, everyone, and a good day to you all.